Hey there, it's Tom Ryan, founder and CEO of ICR. Before we get into the next episode, I wanted to ask that you subscribe to the show. It'll help us get even more unique and interesting guests on the podcast and in turn continue to educate management teams and the growing ecosystem that creates value for fast-growing private and public companies. And while you're at it, head over to Apple Podcasts and leave us a 5-star rating. Very much appreciated.
Quite often, our store managers know the majority of the customers coming through the door on a first-name basis. And that familiarity, because they're from the neighborhoods and know everybody there, really has created a good sense of community and ultimately translates into good loyalty.
The African American community has long been an underappreciated and underserved segment in retail. But one retailer is tailoring their offerings to specifically meet the demands of that community. And as a result, they've fostered incredible brand loyalty and seen incredible profits.
Our top line revenue in 2025 is going to be approximately $820 million.
My name is Tom Ryan, and this is Welcome to the Arena, the ICR podcast. Each week, I sit down with today's business leaders to give you an inside scoop on some of America's most prosperous public companies, their origins, their challenges, and the keys to their success. Today's guest is Ken Seipel, who has served as Citi Trends CEO since November of 2024. Ken has served as a director of the company since 2019, and in April of 2025, he became chairman of the board of directors. He has extensive retail leadership experience, formerly serving as CEO of West Marine from 2019 to 2021, and served from 2013 to 2017 as the CEO of Gabriel Brothers. Ken was also formerly the president and COO of Wet Seal, and he has also had various leadership roles at Old Navy, Target, and JCPenney, to name a few. Let's enter the arena with Ken Seipel. So you've had really an amazing 40-year journey in retail. Maybe you're a glutton for punishment, I don't know, but you're obviously really good at it, from JCPenney to Target to Old Navy to everything else you've done. Maybe tell us more about that. What drew you into retail in the beginning, and how did the Citi Trends opportunity come to you?
Yeah, for sure. Yeah, my early days in retail were really focused on the Fortune 100 companies, as you mentioned. I was lucky to be with JCPenney in their days in the 80s, in their heyday, actually. Helped develop the brand Target in the 90s for almost all of that time, and their rapid growth through there.
Yep.
Had an opportunity to join Old Navy and also lead and participate in their expansive growth. So I really had a really good run in these public companies. But starting about 2010, I decided I wanted to get into more of an entrepreneurial type role and got connected with private equity, which is part of the other background.
Yep.
What kind of led me into Citi Trends, after my West Marine assignment, I had semi-retired, went on to the board of directors, but I really found Citi Trends a very unique opportunity. The company had built a pretty competitive position within the off-price retail sector. Really, frankly, the only off-price retailer focused on African-American customers. There's a highly frequent consumer and really a competitive moat because the store locations were difficult, if not impossible, to duplicate. And you throw on top of that a debt-free balance sheet. And it really became an obvious opportunity. So as I studied this opportunity, what I really learned is that the challenges ahead for Citi Trend were generally all internally controlled and not externally influenced. And so that kind of helped me think through getting a clear, tangible, and controllable path to shareholder growth. And it became an easy decision to join the company at that stage.
Yeah, we'll get to the specifics, obviously, of Citi Trends and where you are in that journey in a minute. Mm-hmm. But I did want to ask you a little bit about the 3 successful retail turnarounds you've done. Were there any commonalities in those that you were able to bring to Citi Trends?
I found that in most of them, first and foremost, they had lost track of their core customer.
Yep.
You can see that in many of the companies that are struggling today, or perhaps have even gone out of business. And our prior strategy at Citi Trends was to appeal broadly to a multicultural consumer, and no one even knew for sure what that meant. So step 1 was getting focused back to the core customer. The next piece is getting the organization really aligned and realigned in many cases, their product strategies, the org charts, the operations to better serve that consumer. Oftentimes those things get askew.
Yep.
And so really dug into getting that done as the next step. And then ultimately the big thing is creating a list of value creation activity and initiatives in the order of significance that add value to the company. being disciplined to kind of work through that list. And then I'd say the final thing is getting KPIs in place that really help you gauge success and or course correct if needed.
For those that don't know the brand, maybe tell us the size and scale of it right now, the number of stores, where you're located, general sales. I know you've given some guidance, but it's a big business.
Yeah, it is. It's probably one of the larger businesses many people have never even heard of, actually.
Yeah.
We have 600 stores across 33 states. And as I mentioned, we serve an African-American consumer in their neighborhood. Our top line revenue in 2025 is going to be approximately $820 million.
Yeah.
And we're on a journey to restore EBITDA to a nice level as well.
And then I think another thing that's very important for shareholders and certainly all the stakeholders of the company is that you're the second largest investor in the company. You've got some serious skin in the game. How does that personal investment kind of change your perspective when you're approaching the business and your strategy and turning this thing around?
Yeah, as I mentioned earlier, I do have a bit of an entrepreneurial spirit about me. And so I like to effectively put my money where my mouth is, if you will. And that has created really strong alignment with our shareholders. One thing's for certain, when I'm at the table leading and guiding company strategies, we're acutely focused on what are the value creation activities that'll help us maximize shareholder returns. And I kind of find that the clarity of that helps us filter out ideas that may be nice to have, but are not necessarily clearly aligned to value creation. So it's helped me prioritize and stay very, very focused on driving business improvement.
Yeah. Talk about the off-price retail model for listeners who may not know. What is the off-price model?
The off-price model is really quite a unique model that really thrives on disrupted marketplace. In effect, what happens is, in many cases, vendors will have product that they have procured or have secured through other retailers. Those orders get canceled. Things happen. Obviously, in the world of tariffs, there's a whole other opportunity there for disruption. The off-price retailers, in our case, Citi Trends, we go to market and we negotiate and find opportunities to really get exceptionally good product at amazing prices. We call it the treasure hunt. But that particular model actually really has a lot of value and a lot of appeal to the consumer.
Yeah. The retail landscape in general, obviously very competitive, and a lot of major players sell to the African American community. Why is this particular concept so defensible, in your opinion, Ken?
I think we were really the only retailer acutely focused on the African American consumer as we're in their neighborhoods. And that's important because to shop with the competition, they literally have to drive right by our parking lot.
Yeah.
And I tell my team this all the time. I said, our number one job is just to get them to turn in here first.
Yep.
And we're beginning to do that. And we do that by, having better styling, better pricing, and better trends, because we do have a significant advantage of our neighborhood positioning.
Yeah. I read, and correct me if I'm wrong, that about a third of your customers go there every week.
Yeah, that's correct.
That's unbelievable.
It really is. I've been doing this a long time, but I've never really seen that level of engagement, to be honest with you.
Yeah.
And they're fairly good income consumers as well, in the $75,000 to $150,000 income range. So they're with us frequently, they buy frequently. And so what we've learned is that the more that we can supply fresh, new, exciting product, we're seeing that in our traffic, and our transaction trends continue to accelerate as this customer continues to buy and become more important in our model.
Yeah. You mentioned your store managers, and in any retail business, that person is absolutely so critical. How do you find those people? How do they become woven into the neighborhood fabric, which has to be like a huge driver of trust and loyalty and visits?
It absolutely is. In most cases, our store managers grew up in the neighborhoods. They've gone to church with everybody. They do the school activities. They've raised their kids.
Yep.
And it's an interesting thing to see when you go into our stores. Quite often, our store managers know the majority of the customers coming through the door on a first-name basis. And that familiarity, because they're from the neighborhoods and know everybody there, really has created a good sense of community and ultimately translates into good loyalty. We found that a good manager from the neighborhood is just completely invaluable and is one of our secret weapons, if you will, against competition.
Yeah. And I know you have a phrase that you use: styles that you see, prices that amaze you, and trends that tell your story. What does that actually mean in practice?
Basically, our job here is to appeal to the consumer's sense of style. And so simply put, we're kind of committed to ensuring that the styles we offer are appealing to their personal sense of style, that the trends that we have in the store are current and relevant, and we have prices that are amazing. When you look at it, you go, wow, that's an incredible value.
And I know you have a 3-tiered product strategy. How does that dovetail with pricing and that overall selection?
Our 3-tiered strategy is really designed to appeal to all income levels. So we offer a good selection of opening price point product. They're value-focused basics. We got them clearly signed for the budget-conscious consumer. The core of our business is kind of the better tier, and these are good quality products that are between $7 and $12 in price point. This drives loyalty, consistent performance across all of our category lines. And then we have at the top end for our more affluent consumers and more fashion trendy consumers, we offer a best tier.
Yeah.
And we do that kind of in 2 ways. There's trend relevant product and styles, like, for example, emerging street brands that are out there in retail right now. And then also, as I touched on earlier, the extreme value capabilities that come through the off-price channel. These are the well-known brands that are sometimes 75% MSRP.
Yep.
So all of this is kind of designed to broadly appeal to our income consumer base.
You talked earlier, Ken, about shopping. It's obviously a necessity, but also an enjoyable activity. And that leads back to the treasure hunt experience. Drill down a little bit more on that. How does that create frequency and just like a fun time for your customers when they come in the store?
Yeah, I think contrary to maybe historical belief, retail shopping is still very relevant.
Yeah.
And for consumers, it's a bit of an enjoyment activity. It's going in to look and see what might be there, what values are there. And this idea that the treasure in the treasure hunt is that unexpected item that you find. And it could be a brand, it could be a style, it could be a price, but something that you see that you just didn't expect to find.
Yeah.
And that drives just a real sense of excitement and enjoyment. I use the term quite often, savvy shopper, because oftentimes what happens with that consumer when they find a great deal, you have to understand it's really not a great deal until you leave the store and go tell somebody about it, right? Yep. Then it becomes a great deal. And so that word of mouth drives frequency, but also we know that we have to drive a little bit of scarcity, because you have to have a sense of urgency while you're in the store to purchase it, because if it's gone, and here comes another deal next round. So
right.
The whole thing really is an emotional appeal. It's about the enjoyment and almost, if you will, the conquest of finding exceptional deals. And that's what I term the savvy shopper.
We're going to get into the turnaround here, which has been just really impressive. I know you've described the transformation in 3 steps: repair, execute, optimize. Maybe talk about each of those and where do you think you are in that journey?
Yeah, for sure. In the repair phase, there we kind of focused on restoring fundamental and foundational practices.
Yep.
This was just to ensure that we have a good foundation for growth. So that kind of included getting a little sharper, more refined clarity of our African-American consumer that I mentioned. That we implemented the 3-tier product assortment to appeal to all income levels. We've added AI-based software for product allocation. This is helping us to improve in-stocks, reduce markdowns, speed up inventory turns. There are many, many more practices, but it was really about fixing the broken things so that we could ensure that we could consistently execute. And then as we get into the execute phase, which is the area that we're really focused on right now, here we're focused on implementing best practices in all areas of the business. This is really about improving productivity, which will eventually allow us to get better SG&A leverage. So we're focused on increasing the speed of our supply chain, reducing cost, and making sure that repetitive activity is out of our business so that we're significantly more efficient and we're able to consistently execute the brand. And also, along with that, we introduced a pay-for-performance program, which is really linking our bonus eligibility to EBITDA and KPIs for each area of the store. So as a result now, our teams are incented more than ever just to drive measurable results, continuous improvement.
4-wall improvement there, Ken, or the overall consolidated EBITDA?
Consolidated EBITDA.
Got it.
We're primarily focused on that. Back to shareholder value creation. It is really the key point.
That's it.
Yep, it sure is, yeah.
So Ken mentioned AI there, and Citi Trends is using it in several different facets of the business, where its predictions have been up to 90% accurate. I asked Ken how these powerful new tools are impacting their overall strategy.
There's actually two parts of this. So there's an AI tool that we've implemented for store allocation, which has been a game changer for us. And that's really helped us to kind of anticipate needs of consumers. And we're actually looking forward now to understand demand trends and to kind of fuel product into stores where the demand is there. And that's really helping us drive significant sales in many of our stores. The 90% accuracy is actually to do with our real estate selection tool. We've done some homework on that. We've fed 3 years worth of transaction data into the system, along with a lot of geolocation data. We have a really good fix on who shops with us, the frequency, and so forth. And all of that has allowed us now to get a model in place that gives me a 90% accuracy when it comes to new store site selection.
Yeah.
And it helps me to kind of minimize the risk of growth going forward.
Yeah. What other technology investments are you making? What are you seeing technology-wise that is something that you can easily dive into and improve the customer experience with?
The next phase of our AI-based allocation is to get into merchandise planning and assortment planning. And while that's a little bit invisible to the consumer, it's actually critical because that'll actually help us with our financial investment in product and then help us deliver a better breadth of style and selection at the store level. So that's actually phase 2. And then also we're concurrently working on rolling out a CRM program, which should help our consumer actually have a much better relationship with us, make it easier for them to shop, and also for us to communicate with our core customers. So those are the two main things that are on deck right now.
Well, Ken, you've talked about this journey as kind of repair, execute, and optimize. You're certainly executing, and a lot of people just say it, but you're actually doing it. 5 consecutive quarters of industry-leading comp store sales growth with your 6th one on the way. How is it all kind of coming together in your mind to kind of drive those kinds of results? Because they're very impressive.
Well, thank you. I would say that we're still in early stages. What has really been incredible for us is that our consumer has really reacted strongly in a positive way. Most of the growth that we're driving right now is increased transactions and a little bit on our shopping basket. So it just says that our customer is liking where we are. And that has really been the wind in our sails, if you will, to drive this turnaround. Though what we're trying to think through as a company is how do we make sure that we stay grounded, disciplined, focus on the details, consistently execute. And our strategy for the most part, and really the initiatives that support it, are really not aspirational. These are actionable things that are backed by a set of initiatives here that we're trying to deliver measurable results. And so it absolutely for us is a journey. As I described to one of our shareholders the other day, I would say if this were a baseball game, we're kind of at the bottom of the 3rd inning.
Yep.
And we have a lot yet to prove and a lot more to execute to get better, but we're certainly on the right path.
Well, one of the levers you have for growth is new store locations, and I think you're on record talking about 650 or so by 2027. AI is going to help you do that, but there's also remodels. Like, how do you think about new stores, where you're going? How are you sprucing up the system?
Yeah, for sure. There's a couple things to say about that. One of our primary goals is to drive market share. So remodels are being used in conjunction with new store growth to think about a marketplace. And as we were looking at various MSAs across the country, we're asking ourselves, have we maximized our opportunity here? And in some cases, it's a matter of doing some remodels. In some cases, it's a backfill. It's a close relocate of a store. But we actually are taking a very strategic view at various MSAs across the country to ramp up our store growth and for new stores, as well as back that up with remodels. We just tested 2 markets, one in Jacksonville, Florida, and the other one in Columbia, South Carolina this past fall, where we've done exactly that. We've added marketing, we've refreshed all the stores, and we've added new stores to the market. So far, we're off to a good start, and we're learning a lot about how we can maximize that. So step 1 of growth is maximize MSAs where we know we can do business. And then step 2 in our new stores, we're using a disciplined 3-part approach, as we talked about the AI tool already. We're also using boots on the ground, which is the local brokers and the intel that's out there. And then, of course, we have a disciplined financial model to drive ROI, and we'll be using that to go out into new expansive markets. As I mentioned, we're in 33 states, but we have some opportunity to continue greenfield growth.
It sounds so easy when you talk about it, Ken, but it's a lot of hard work by a lot of really smart and hardworking people. So, getting everybody pointing in the same direction is really difficult. So congrats on that. I know your gross margin expansion target is 400 basis points. What are the drivers that are going to make that happen?
That's right. So part of that is looking at markdown improvement. We believe by improving our allocation to various stores and reducing the liability product in stores that don't need it, we're going to see a nice positive improvement over time in our markdowns. The next piece of that is shrinkage. We've recently deployed facial recognition cameras in actually the majority of our stores. We'll have it out in all stores by the end of Q2. And that's really helping us now elevate our ability to manage shoplifting and shrinkage.
Yep.
And we expect to see shrinkage control as a part of this. And then the final piece of it is also driving better improvement in our transportation and inbound freight lines. Those areas right there, we have very tangible activities that'll help us with gross margin expansion.
Yeah. And I know you're talking about 200 basis points of SG&A leverage. The key there, though, is while still being able to invest in growth. Maybe talk about that.
Yeah, for sure. So the growth plans, we're taking basically our operating capital that's being generated by the business, and we're using that capital to put back in as our growth capital. And along with that, what we're doing is we're saying, okay, in many cases, we can actually now leverage our infrastructure as we grow. So whether it's our corporate headquarters or our buying offices, different things like that, we're finding real opportunities here that we don't have to add a lot of infrastructural cost to actually drive the growth that we have. So the SG&A and the profit flow through, and I believe for sure in 2026, we'll see a strong profit flow through happening inside of the business. And that'll be our discipline going forward as we expect to grow with minimal capital and minimal SG&A investment in the business.
So you mentioned in the very beginning of the podcast, a debt-free balance sheet, strong cash generation. And I have to imagine over your career, you've seen some train wrecks, where companies are over leveraged and they miss the season on retail or other things like that. How does that financial strength kind of shape the way you think about expansion and strategy and maybe just, I don't want to say be freewheeling, but maybe just have a little bit more confidence that the margin for error isn't so razor tight?
Indeed. Well, it's kind of quite simple. When we have cash flow generated in the business as we are doing now, we can take that cash flow and decide how much of that we want to reinvest in the business and growth. Where companies that are encumbered by debt, and I've seen, unfortunately, a few of them over the years, basically the number one thing they have to do is go back and pay back their interest on the debt.
Yeah.
And then ultimately hope that they can retire debt. We don't have either of those decisions to be made right now. For us, cash can be converted into shareholder value creation. So it's liberating, but with it comes an incredible responsibility, right? Because to maintain a strong cash position, it means that we have to have discipline behind the scenes on return on investment activities. So we're pretty tightly controlled and tightly measured and metered around return on investment and really making sure that everything that we do has a strong payback within an acceptable period.
I have to think that as a large shareholder, you're thinking long term. One of the things I've seen in my career looking at companies and stocks and things like that is, a company finally is turning around, they have a debt-free balance sheet, and then a hedge fund person comes to you and be like, why don't you lever up by 50%? You have to really resist that, don't you?
100% have to resist that. In addition to some of the work I've done in the past, I've actually done quite a bit of consulting work as well for a lot of PE firms. And quite often you see exactly that problem where it's too tempting for them to come in and lever up a balance sheet and get a 5X or 10X or even 7X leverage on that and recap and get their dividends back and all those good things that look good on a spreadsheet. But in very rare practice does it help a company, quite often cripples it. So those lessons are ones that I think we all learn over time, and certainly here at Citi Trends, we will not repeat those type of lessons. Well, if in fact we take on debt down the road for growth, which I'm not anticipating, but if we did, it would always be done at a nominal level.
Very smart. So when you roll a lot of this up, I know you're projecting $45 million in EBITDA by 2027, and I think that's a $60 million swing from 2024, which is ambitious and impressive. How do you have the confidence in that number? Because it's a huge improvement.
We have actually very high level confidence in the number. And as I mentioned before, it's because we actually have a value creation strategy in place that has very tangible actions. And I can actually go down in descending order and tell you precisely what activities we need to do to add value to the company and ultimately deliver that $45 million of EBITDA. So it's not a mystery. All we have to do is just simply execute. And right now, we're not worried about hitting 45 million. I'm actually thinking about what do we do beyond that?
Yep.
And how do we keep pushing beyond that? Pardon me for sounding confident, but I do have a very high confidence level in our ability to get it back to 45 million.
And then my last question, Ken, is I always think when you look at most companies, you can only do a few things every year at an exceptionally high level. As you look to calendar 26, what are the 1 or 2 or 3 things that you're really focused on?
At 26, we have really, simply put, we've got to be better at executing, and as I mentioned earlier, we've got a lot of our processes in place and things to work on in terms of our replication of the business model, and we're doing a pretty good job with it. But 2026 is really us getting much, much better at swift and consistent and first-time execution. The other piece of it is we need to prove out our growth strategy. As I mentioned earlier, we're ready to accelerate in new store growth, and we have some markets underway. We have a lot of remodels underway, 63 last year, 50 this year.
Yep.
We're going to continue to drive that. And so making sure that we stay focused on that and that we maximize the growth. So those are the 2 big things on the to-do list this year. And then the third thing for us will be to develop strategies to push well beyond the 45 million of EBITDA, as I mentioned earlier.
That was Ken Seipel, Chairman and CEO of Citi Trends. They're in the middle of an impressive turnaround story and staying very focused on the African American community, which is both underserved and a protected niche in retail. And this isn't just talk. The financial performance has been there with 5 consecutive comp store sales growth quarters, and they're well on their way to a 6th one. I think they really have a lot of levers at their disposal to create value, and it'll be very interesting to watch them execute on their new strategy and find new ways to engage their core customer base in the years to come. I'm Tom Ryan, and we'll see you next time back in the arena.
References to specific stocks are not intended to be recommendations for specific trading behavior. Comments presented on this podcast are intended for informational and educational purposes only, and do not represent opinions or recommendations on whether to buy, sell, or hold shares of a particular stock. All investors are advised to conduct their own independent research into individual stocks before making a trading decision. In addition, investors are advised that past stock performance is no guarantee of future price performance.